to all of our viewers. My name is David McGann. I'm a director here at BMO InvestorLine, and I'm thrilled to be co-hosting today's webinar on getting started with options in partnership with Options Plan. With me, I have Tony Zhang. Tony is a chief strategist at Options Play, where he leads development of options trading products, education for investors, and oversees the firm's quantitative options research. He is a frequent contributor to CNBC for analysis on the markets with a specific lens using technical analysis, fundamentals, and options. So we truly have an industry expert here today to help us kick off a tremendous new education and content series geared specifically towards options. And with that, Tony, I'll hand it over to you to take us away as we dive into this topic of getting started with options.
Thank you so much, Dave, and thank you so much to everyone here at BMO. I'm really excited to be launching this series on helping investors better understand options, option contracts, and how to think about how options fits into your portfolio. So thank you so much, and let's go ahead and dive right into it. So let's get started here today with our first webinar in our series, which is getting started with options. In this webinar, we're going to explore and understand the basics of an options contract. We'll talk about buying and selling calls and puts to better understand the different types of strategies that you could potentially deploy in your portfolio and how you should think about options fitting into your overall portfolio, whether it's for generating income, speculating on the overall direction of the overall market, or even potentially protecting your portfolio against some downside. So let's go ahead and get started. Now, before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. So let's kick off and take a look at what we are going to cover here today. First and foremost, we want to make sure you understand what an option contract entails, the difference between a buyer and a seller of an options contract, and the difference between a call and a put options contract. Then we'll take a look at an example to give you a better understanding to compare in the exposure that you have with an options contract compared to the exposure that you have owning the underlying stock. And this giving you that comparison will give you a good understanding of the differences and when you might want to consider using an equity exposure or an options exposure. And then we'll take a look at why do investors typically utilize options. We'll be taking a look at a few different use cases to generate income, to speculate on the overall direction of the markets, as well as how to protect your portfolio against some downside correction in the overall markets utilizing options. And lastly, we'll wrap this up with some best practices on utilizing these option strategies before I'll hand this back to Dave to show you how to utilize the InvestorLine platform to find and utilize some of these strategies. So let's kick off with just a basic understanding of what is an option, because the first time you look at an option contract, it might seem a little overwhelming because it's actually some legal it's essentially a legal document. It is a contract between a buyer and a seller. And what we're going to do is we're going to break down this contract to help you better understand the terms of the contract and what you might be obligated to or have the rights to as a buyer or seller of an options contract. So first and foremost, the most simple thing to understand is that an option contract is simply an agreement between a buyer and a seller. And in this particular case, the buyer will always be the party that's going to pay a premium in order to have the rights to the contract. And the seller in this particular case will be the receiver of the premium that the buyer pays, which sometimes we refer to as the income that you receive as selling an options contract. And as a seller, what you have is the obligation to fulfill the terms of the contract if and when the buyer chooses to exercise those rights. So sometimes to better understand this, we use a bit of a metaphor. We think of it as driving a car. The buyer is the person who's the driver of the car. They are going to maintain control. They pay for that right. And the buyer gets to control whether we go left or right, and they choose whether they want to exercise the rights. And as a seller of an option, as a writer of an option that gets paid that premium, from the buyer, you are effectively in the passenger seat. You are at the whims of what the driver, where the driver wants to go. So that's why, as a seller, you have the obligations of the contract that if the buyer chooses to exercise his or her rights, you have the obligation to have to fulfill that obligation.
Thank you, Tony. Really appreciate that walkthrough, and I love the use of metaphors. And I think when it comes to retail investors, historically, there's been more of a skew towards being a buyer and a driver, to use your metaphor, versus a seller. Have you seen this dynamic change over time? And if so, why?
That's a fantastic question, Dave. And I've been doing this as an option strategist for 18 years, and over that time frame, I certainly have seen a lot of changes with regards to how investors are utilizing options. 18 years ago, when we look at the retail landscape, predominantly retail traders were largely buyers of options. And it was actually the professional community, the market makers, the institutional investors that were predominantly selling options, collecting premium, collecting income on options, on selling options. But over the last few years, we've really seen a resurgence of the retail trader in terms of their education, access to understanding these strategies on a much deeper level, understanding the underlying Greeks. And what we have seen as a result of that is far more, I would say, a balanced approach for retail traders that have, a far more balanced approach to not only buying options, but also selling options. And we're seeing a lot more retail traders actually selling options these days than we did looking back, a decade ago. So with that, let's dive into the anatomy of an option. This is really where we break down the legal terms of the agreement between the buyer and the seller. And once we go through this, you'll have a much better understanding of how to navigate and understand an options contract. So first, let's take a look at the terms at which we agree to between the buyer and the seller. The first term we look at is the contract amount. How many underlying shares does each contract represent? Now, with most stock, ETF, and index options, the contract amount is a 100 multiplier. So either 100 shares or 100 times the index level. Each contract is going to represent 100 shares. And you can trade multiple contracts, but the minimum contract you can trade is one contract. The second thing you're going to agree to is the underlying product or the underlying asset. This could be a stock, an ETF, an index, a currency, or a commodity. Most traditionally, you're going to see ETF stocks and indices that are traded on the US and Canadian exchanges. So in this particular case, we're going to use an example with Oracle stock traded on the New York Stock Exchange. The next thing you're going to look at is the price at which you agree to, typically called the strike price. And this is priced in dollars per share. And what you're doing is you're agreeing to a price at which you can either buy or sell the underlying stock at sometime on or before the expiration. And that is the last term that we look at, which is the time frame. At which point does the option contract expire, meaning the buyer has the rights to buy or sell this stock at the specific price up and unto that expiration date. In this particular case, we're looking at April 19th at the time. So this gives us a better understanding of the terms that we agree to. And the only thing that we have to then specify at the end of this is whether it's the right to buy the stock at a specific price or the right to sell the stock at a specific price. And that will determine whether it's a call option or a put option. So this might start to sound a little overwhelming with the number of terms that you have to agree to, the calls and puts, whether it's a buy or sell. So let's take a look at a real example here of Oracle stock. Let's first take a look at the call option example. What this gives us is the right, as the buyer of the call option, the right to buy 100 shares of Oracle stock at $100 per share on or before the April 19th expiration. So the goal here is to make sure that when we look at the contract, you understand the terms at which you're agreeing to. And in this particular scenario, if you were to buy this call option on Oracle stock expiring on April 19th for a $100 strike price, let's take a look at the three different scenarios that you might come across as the buyer of this call option. So first scenario that we'll take a look at is if at expiration, the stock is above $100 per share. So what this means is that typically you will likely exercise your call option because you can effectively buy the stock at $100 per share for a stock that's actually worth more than $100 per share. And that is going to be beneficial to you as the buyer of a call option because you can effectively exercise your call option, buy the stock at $100, and immediately sell your stock on the open market for a price that's higher than that. And that would be the potential profits that you have on the contract. The second scenario that you might come across is if the stock stays at $100 or lower before expiration. And this is really when we say that your option is out of the money because in this particular scenario, you would generally not exercise a call option for $100 per share if the stock was worth either $100 or lower, because there's no economic benefit to doing so. You're better off just either buying the stock on the open market for the current price at either $100 or lower. In this particular scenario, the call option that you purchase will simply expire worthless. And in this particular case, because as a buyer, you paid a premium to enter the contract and the contract expire worthless, you effectively lost the premium that you've paid as the buyer if the option were to expire worthless. But what's actually more commonly done in this scenario is that likely before expiration, when you purchase an option, that option will fluctuate in value based on the underlying securities price, based on volatility, based on how much time is left before expiration. And what you can do is simply sell the option contracts that you had purchased. So if you had purchased the contract originally for $5, whether that contract is now worth $10 or worth $3 based on where the stock has moved over time, you can always just sell your contracts on your option contract at the current price and realize either a profit or gain by simply selling the option contract itself. So those are generally the three scenarios that you'll find yourself in either at expiration or prior to expiration that will typically determine whether you hold on to a contract or let it whether you hold the contract to expiration. And if we look at a put contract, it is very similar, just the mirror image of that, because now instead of the right to buy the stock at $100 a share, you now have the right to sell the stock at $100 a share on or before the expiration date. So let's go through the scenario here again. Let's say you bought a $100 put option on Oracle stock that expires on April 19th. If the stock in this particular case was trading below $100, just like the call option, this option is now what we call in the money because you can now sell the stock at $100 and effectively buy it on the open market for a lower price. And this allows you to, or rather buy the stock at the open market at a lower price and immediately sell it to the seller at $100, realizing the difference between the price you bought the stock at currently and the $100 a share that you can sell it for at the very moment. Now, this is really when, if you hold the option contract to expiration, you can exercise that right and realize the profits between the current price and the strike price. Or if, let's say, at expiration, the stock is at $100 or higher. Now, in this particular case, it doesn't make economic sense to exercise your put option because if you sell the stock at $100, but you have to buy it back at a higher price than it currently trading for, then that doesn't make any economic sense. So in this particular case, we consider the option worthless at expiration. And just like the call option, if an option that you purchased expires worthless, you have effectively lost the premium that you have paid for the option contract, and you will have a loss on that specific trade. And in the third example, if, let's say, the option contract that you purchase over time, as the stock fluctuates, as it goes higher or lower, and time passes by and volatility changes, these are all things that are going to affect the value of your option. If you purchase that option for, let's say, $5 per contract, that option contract will fluctuate in value, and you can always sell that option contract sometime in the future for that price. whether that will turn into a gain or loss in the underlying contract will determine what your profits or losses are for that contract. So hopefully this gives you a better understanding of if you were to buy or sell, a call or a put, what the different outcomes that you might find yourself in and what that might mean for your underlying portfolio. So I've always found that because you have calls, you have puts, you can be the buyer of a call or a put, you can be the seller of a call or a put. This can be very confusing for a lot of first-time users of options to try to remember all of these different scenarios and when you might use it. So one of the best ways, in my opinion, to remember this is to use a simple T-chart. What we have are calls and puts on the top, calls and puts on the bottom. I'm sorry, we have bullish strategies on the top, bearish strategies on the bottom. You have calls on the left, and you have puts on the right. So what you have is a long call and a short put are both going to be bullish strategies. Now, what we refer to a long call is simply the buyer of a call option. And when we refer to a short put, we're referring to the seller of a put option. So when you buy a call option, that is a bullish strategy, which gives you the right to buy the stock. And then when you short a put option, this is also a bullish strategy that gives you the obligation to buy the stock. Now, whenever you're looking to buy the stock, you want the value of the underlying to rise in value, which is why we say that that's a bullish strategy, and vice versa. We just refer to buying a put option as being a bearish strategy, which gives you the right to sell the stock at a specific price. But a short call, meaning if you were to sell a call option where you collect a premium and gives you the obligation to sell the stock, those are also bearish strategies, because any strategy where you have the right or the obligation to sell the stock, you generally want the value of the underlying security to decline in value. So the T-chart is a great way to help you remember which strategy is going to be bullish, which strategy is going to be bearish, and always remember calls on the left, puts on the right, and the ones on the top are going to be the bullish strategies, and the bearish strategies are the ones at the bottom of the chart. So in order to better understand these strategies, it's always best to just go back to something that we have a better understanding of. And I think most viewers here have a better understanding of buying and selling stocks than you might have on option strategies. So let's do a comparison here of the exposure that you have in your portfolio when you own an underlying stock or ETF, and compare that to what it looks like relative to the option. And that will help you better understand when you might want to utilize an equity exposure and when you might want to use an options exposure in your underlying portfolio. So let's first take a look at stocks. What do you get when you own a stock, and what do you get when you own an option? So with stocks, you own a stock because you believe it's going to appreciate in capital. That's the first and foremost of why you own a stock or ETF. You believe it's going to rise in value sometime in the future. And when you own that stock, it gives you an actual slice of ownership in the corporation or the ETF that you own in that portfolio. And this gives you the rights to the dividends, as well as any voting rights that come with that underlying stock. And the benefit of a stock investment is the fact that the time horizon you have on it is effectively infinite. You can have any time horizon. You can hold on to a stock for a few minutes or a few years, however long you'd like to hold on to that security. As long as you have the margin requirement to hold on to it, you can hold on to it for as long as you'd like. Now let's compare that to an options contract. When you buy an options contract, it gives you the rights to buy or sell the stock at a specific price on or before the expiration date. Those are the terms of the option contract that we were referring to before. Now, here your goals are going to be quite different. It depends on whether you believe the stock is going to move materially higher or lower, or if you believe the stock is just going to stay where it is. But option contracts give you a lot more optionality, versus when you buy a stock, you only own it because you believe it's going to appreciate in value. With options, you can trade them in all different outlooks, whether you think it's going to move higher or lower, or even if you think it's just going to stay where it is. There are option strategies that can allow you to profit in all of these different scenarios. Now, there are going to be some trade-offs with options because you don't have any dividends that you're going to be able to collect from the underlying security if you own the option, and you won't have any voting rights in the underlying security as the owner of an option. And option contracts, unlike equity securities, have a time horizon. They expire on a certain date, and either the outlook that you have achieves that objective within that time frame or not. You only have until that time frame in order to exercise your rights. So those are some of the things that are important to pay attention to as an options investor that is going to be different from an equity investor. Now, the next thing I think it's important to understand is what influences the value of the stocks that you own or the value of the options that you might own in your portfolio. So when we talk about stocks, we're really referring to the earnings, the revenue, and how the management or the executive team of a company is managing the outlook of that underlying security. And many investors will typically look at technical factors, looking at the underlying chart to help determine where they feel that the stock will be sometime in the future, as well as fundamental analysis, looking at valuations, looking at income statements. They understand how the business is doing. But typically, an equity investment does require a larger capital outlay. And the benefit that I think for a lot of investors from a simplicity perspective is that stocks give you symmetrical exposure, meaning you know exactly how much money you would make if the stock were to rise by $10, and you know exactly how much money you'd lose if the stock declines by $10. And it's a symmetrical amount of risk. If it goes up by $10, you make a certain amount, and if it goes down by $10, you lose the exact same amount. So it's a symmetrical risk profile, very easy to understand. With options, you start to add some complexity because it's not just the earnings and revenues and where the stock is going that's going to impact your P&L. There's going to be multiple inputs that are going to affect the value of an option. The underlying security is going to be the primary driver of the value of the option. However, volatility, time, and even interest rates will have an effect on the underlying value of an options contract. So you are adding some complexity in terms of what factors are going to affect the options price, but it does require typically less capital to enter an options trade than in a securities trade, and we have what we call asymmetrical risk. This is what we as options traders refer to as convexity, something that if you've ever wondered what you're ever going to do with the things that you've learned in calculus back in high school and college, well, this is one of the places that you can actually apply those terms, because an option contract, the payoff diagram of an option contract is not linear. In certain instances, you're going to accelerate in terms of potential profits, and in other cases, you're going to decelerate in potential risk. And these are all trade-offs that you can make, and by determining which option contracts you trade, that gives you a better sense for how asymmetrical your risk profile is going to look like. And those are some of the things we're going to dive deeper into as we look at some examples and as we progress into other parts of this webinar series. That's going to give you a deeper dive into what is going to affect the value of an option and how much it's going to do it by.
Tony, I'm going to jump in for a quick minute here. And, I know you did introduce some new terms. And of course, you mentioned that we'll have more content in the series that dives a lot deeper into some of the terminology with options. I think one term for options traders that's pretty common is delta. And maybe for some of our newer to options viewers here today, it would be great if you could elaborate a little bit on what delta is and why it's something option traders often reference when they're researching or evaluating their options positions.
David, that's a fantastic question. It's actually one of the most important, I would say, terms and technical aspects of options trading that traders should understand before they dive into actually trading an option. When we refer to delta, what we're actually trying to understand is that effect of the underlying security's value on the option contract, right? So we referred to before, when you buy a stock, we refer to a stock position as delta 1. What that means is that for every $1 the stock moves, your investment will either make or lose $1. So if you own 1 share of the stock and the stock moves up by $1, you'll make $1 in profits. And if it goes down by $1, you would lose $1 in losses on that security. That's why we call it a delta of 1. It's a 1-to-1 relationship between where the stock goes and what your P&L is. Now, with option contracts run a wide gamut of deltas between 0 to 1. Meaning, if you buy an option contract with a delta of 0.5, that means for every $1 the stock moves up by, your option contract will increase in value by half that amount, or 50 cents. So, and vice versa, if the stock were to decline by $1, that value of that option contract will decline by 50 cents. And you can choose different deltas for different option contracts. So some option contracts may have a delta of 0.9, some option contracts may have a delta of 0.1, and you have a choice as to how much exposure you want to the underlying security, and the different exposure levels will cost a different amount in terms of the premium that you have to pay. So really fantastic question, but we'll dive into that, delta and the other Greeks in the webinar that we will be covering on option Greeks. But really good call out here, Dave, to better understand kind of how the underlying security affects the value of your option, which is that term delta that you might hear as you learn more about options. So let's take a look at, now that we've explored kind of some of the terminology, some of the terms that you're agreeing to as an option, I think it's really always it's always important that we understand, why should I take the time to learn all of these, or add some complexity to my portfolio and learn how options can fit in my portfolio. So I always like to, before we kind of dive more into options and some of the terminology, to take a step back and look at, if you were to take the time to learn about options, what can it do for your portfolio? So what we're going to explore here today are 3 primary use cases that an investor would generally utilize options for in their portfolio. First and foremost, what's probably most popular and what draws most investors in is the concept of speculation. Trying to speculate on the directional view of either the overall market, a specific sector, or an individual stock. And I would say the thing that probably draws most investors in is that asymmetrical risk profile that I was referring to. How can I take a view on the overall, on a specific asset class or a specific security with limited risk, but still get leverage to the upside or unlimited gains to the upside? That asymmetrical risk profile is what usually draws a lot of investors in. But, Dave, you were asking me before, what is the balance between buyers versus sellers? And this is really where I think, while speculation and buying options is what draws a lot of investors in, once investors learn more about options and they kind of understand how they work, we tend to find that income generation tends to be a more common use of options. This is really where these option strategies honestly are not as sexy as buying options, but they create yield on existing portfolios or positions that you might already own in your portfolio. And this is actually one of the most popular use cases of options once investors learn more about how they can utilize call and put options to generate income. And then lastly, we see this is the one that you don't use very often, but sometimes you might feel that the markets are due for a large correction, whether it is a minor correction or a major correction. You might consider utilizing options to protect your portfolio while you can still remain fully invested in the markets. Maybe you want to remain invested for dividends, or maybe you want to remain invested for tax purposes, but you want to protect yourself against some downside risks that you see in the overall markets. Options can potentially provide a bit of a partial hedge on your overall portfolio. So what we're going to do here today is we're going to explore these 3 scenarios and give you a better understanding as to how options will fit into your portfolio for these 3 outcomes. So when we use, the 4 different, the T-chart before that we're looking at, there are 4 different scenarios. When we talk about speculative trading, meaning effectively taking a view on an underlying security and whether you believe that stock is going to move substantially higher or substantially lower, we're typically referring to either buying a call option or buying a put option. This is really when you expect either a big move to the upside or a big move to the downside. And you would look at buying a call option if you believe that the equity, the underlying security has or you have a bullish outlook on the underlying security, then you would typically look at a put option if you believe that you have a bearish outlook on the underlying security, because a call option gives you the right to buy the stock at a specific price. And the goal here is that you believe that the stock will be worth more than that agreed upon price on or at expiration is typically the motivation to buy a call option. So for example, if let's say you buy a call option at a strike price of $100 when the stock is trading at $100 today, because you believe that stock might be worth $120 at expiration, then you would pay for that option so that hopefully by expiration, you now have the option to buy the stock at $100 when the stock is actually worth $120, and you'd be able to realize the difference between the $120 and the $100 minus the premium or what you have to pay in order to get into that option contract. And vice versa, if you were looking at buying a put option, you're hoping that you'll be able to sell the stock at a specific strike price when it's going to be worth less than that price at expiration. And this really, you can think of calls and puts when you're buying calls and puts as sort of mirror images of each other. And keep in mind that, as I said, that even though sometimes you might hold these contracts to expiration, what's more commonly done is that if you buy a call option and the value of the stock increases, then the value of your option contract typically will also increase as well. And a lot of traders will simply just sell the option contract based on the increase in value of the option contract itself and never actually hold these contracts to expiration. So when we talk about speculative trading, we generally refer to just the buying and selling of the option. It's actually not as common as many traders might think to actually hold these contracts to expiration and actually exercise those rights. And keep in mind that you can use a combination of calls and puts and buying calls and buying puts that we will explore in further webinar series that can potentially give you some of the benefits of both worlds as we start to explore speculative trading and income trading, how you can actually combine them together into a single strategy to kind of achieve even far more outcomes than you're looking at as just simply saying I'm bullish or I'm bearish on an underlying security. Next, what we'll take a look at here is income trading. Like I said, I think a lot of investors get drawn into the concept of options trading because they hear about speculative trading, how you can turn a small amount of capital into a large amount of capital in a short amount of time if you were to get the directional view of a stock correct and buy the call and put at the right time. But I tend to find that once investors learn more about options and understand the trade-offs with buying and selling calls and puts, as you learn about selling calls and puts, this is really actually where a lot of investors spend more of their time utilizing options in their portfolio. And it really just comes down to the fact that the amount of time where you feel that a stock is going to make a big move higher or lower is always going to be relatively small versus the amount of time that you might feel that the stock is going to be trading sideways or just not making a big move is probably going to be more common. And that's really where income trading will come into play. We're going to look at two examples. We're going to look at a cover call and a covered put. And from my perspective, cover calls is by far the most widely used option income strategy. It's when you own an underlying security, at least 100 shares of an underlying security, because each option contract is for 100 shares of the underlying stock. So if you own 100 shares of the stock, a cover call is when you sell a call option against the stock that you own, because when you sell a call option, you are obligated to sell the stock at a specific price. So if you own the stock today, what you're doing is you're obligating yourself to potentially sell the stock at a specific price sometime in the future. Typically, you would choose a strike price that's above the current price of the stock, so that if in the future the stock were to rise in value, you would effectively be able to sell your stock at a potential profit once the stock is to rise sometime in the future. But even if it doesn't happen, what you do is you collect premium. That's the income that you're going to receive by selling that call option. So covered calls are by far the most popular strategy, and you typically would do this if you own the underlying security and you're hoping that sometime in the future you'll be able to sell it at a higher price, and in exchange for that you're going to collect some premium. And if the stock doesn't rise to that strike price by expiration, you can effectively keep selling cover calls and keep collecting income month after month, quarter after quarter, as long as the stock stays below that strike price at expiration. And when the stock does rise above that strike price at expiration, you've now effectively sold your stock at that specific price. And hopefully at that point, you would have realized a profit on the underlying security while collecting income when you wait for that security to rise in value. So a cover call gives you the obligation to sell the stock at a specific price. Another popular strategy that, in my opinion, is actually not as utilized is actually what we call a covered put, or sometimes called a cash secured put. And a cash secured put gives you as the seller of a short put, you have the obligation to buy the stock at a specific price. So always think of calls and puts as mirror images of each other. A covered call gives you the obligation to sell the stock at a specific price. A covered put gives you the obligation to buy the stock at a specific price. And this is a popular strategy to acquire stocks at a price lower than where the current stock is trading. So similar to placing a limit order, when you place a limit order, you are obligating yourself to buy the stock at a specific price. When you sell a put option, you are obligating yourself to buy 100 shares of the specific stock at a specific price on or before the expiration date. And basically what you're doing is you're saying, if the market were to decline to that strike price, I would be okay with the obligation to buy the stock at that specific price. And in exchange for taking on that obligation, I'm going to get paid a premium for today. That premium that you collect is the income that you receive on a cash secured put or a covered put. And generally, you're doing this on stocks that you are bullish on long term, but in the short term, you believe that the stock is going to be fairly neutral or even have a little bit of a dip before the stock takes off sometime in the future. And this gives you the opportunity to collect some income and buy the stock potentially at a lower price than what it's trading for today.
Tony, I'm going to jump in. I think it's great that we're talking about, 3 ways to really think about using and trading options to complement your portfolio. You've talked already about speculation. Here we are on income trading. And of course, in a minute, I know you'll expand a bit on hedging. As it relates to these 2 strategies here for income, covered calls and covered puts, I think you touched on this a bit already, but which do you see as being more popular among investors and why?
Yeah, great question. Definitely cover calls by far is more popular. But from my perspective, these 2 strategies arguably should be equally popular, right? Because a cash secured put is a strategy that helps you acquire the stocks that you want for your portfolio, and a cover call, it potentially helps you sell the stocks that you own in your portfolio. So it's really the full life cycle of buying a security and eventually selling that security. So in theory, they should be equally popular, but by far, cover calls are more popular. And I think it has to do with the risk profile of a cover call and also what strategies that you can trade in a tax-deferred account. But cover calls are by far the most popular strategy. But in my opinion, a covered put is the most underutilized strategy by a lot of investors because, it's really a strategy for anyone who's a long-term investor. If you own stocks in your portfolio for the long term, cash secured puts help you potentially acquire those stocks at a lower price at actually less risk than simply buying the stock at outright, because you're getting paid a premium in order to take on the obligations of buying the stock. And then once you own the stock, selling that cover call allows you to generate an additional income stream outside of any potential dividends that you can generate from owning the stock, in hopes that in the future you'll be able to sell the stock at a higher price. Thank you so much, Dave. And then lastly, let's take a look at hedging. And this is really like I said, a strategy that you don't use very often because it's not very often that we believe that the market is due for a large correction. But if you own stocks in your portfolio that you're concerned during a market correction, the value of your portfolio will decline, and for what any reasons that you don't want to sell out of those investments to buy it back later, whether that's for dividend purposes or for tax purposes, a hedging strategy allows you to remain invested in the securities that you own, but protect you against a downside. Now, these are typically partial protection. These are not going to be dollar for dollar protection on your overall portfolio, but this is really where you would either buy a put option or sometimes even consider a put spread. And we're going to cover that in future webinars as to what a put spread is. But what you're doing is you're buying a put option against a broad portfolio, a broad index, whether that's in the form of an index ETF or an index option itself. What you're doing is you're basically buying a put option on a security that tracks the broader markets. And if the markets were to decline, the put contract will pay out or potentially profit from a decline in the underlying markets that will offset the losses that you might have in your overall portfolio. Now, this is really a one that requires a fair amount of skill with regards to timing the markets correctly, because buying a put option on the markets tends to be an expensive exercise. It's not quite like buying insurance that, where you can afford to buy insurance and get coverage, 24/7, 365 days a year. If you were to do that on your portfolio, you would end up paying a very large percentage of your portfolio to buy constant protection. So it doesn't make sense to just remain protected. So you really have to buy insurance kind of if and when you need it. So it requires a bit of skill in terms of timing, and it requires a bit of skill in terms of understanding which option contracts to purchase if you wanted to buy a put option on your portfolio. So this is a little bit of an art, less of a science, but those are some of the things that we will explore in future webinars as we look at buying put options and looking at some of the option strategies themselves.
Tony, this hedging concept, I believe, will be a really interesting one for our viewers to learn more about. And I look forward, of course, to when we have the opportunity in the series as we go forward to dive a bit deeper into this concept of hedging. But can we give our audience a little bit of a teaser, maybe some rules of thumb that are general for consideration when we're thinking about how options can be used to hedge an existing long-term holding? Is there anything you can share, any rules of thumb that they can explore a little bit further offline?
Yeah, absolutely. And this is really where, the world of options gives you a lot of options. But there's generally two schools of thought that I have when it regards to thinking about buying protection in your portfolio. So either you're trying to protect against a general decline in the overall market, right? This is kind of where you believe that perhaps a bull market, we're really late into a bull market, we're due for kind of a fairly sizable correction in the overall market, or you're starting to see, the economy roll over, you're starting to see earnings, corporate profits starting to decline, and you believe that there's going to be a larger downturn in the overall market. The rule of thumb here is that you want to go out at least about 60 to 90 days out when we're picking your expiration dates. You want to give yourself a little bit of time, and you're buying a longer dated option that's going to decay by a lower amount every single day you hold on to that protection, because again, protection is expensive. Each day you hold on to it, you want to make sure that that protection costs you as little as possible. So by going longer dated in options, you're actually going to pay less per day. It kind of goes against the intuition, but actually the longer time frame that you buy, the less you pay per day. And then when it comes to, on the other hand, sometimes you're just trying to hedge against a specific catalyst. So for example, you have an inflation print coming out. Maybe you think that there's a chance that inflation print might surprise to the upside. And sometimes we've seen a lot of volatility following the day or two right after it, and you want to protect your portfolio against that. when you're trying to hedge against a specific catalyst, whether that's earnings or an economic number, then we generally want to go pretty short term. You want to go maybe 1 to 2 weeks out, because what you're trying to do is you're trying to reduce the overall cost of buying that insurance. You weren't planning on holding on to it for very long anyway. So you just want to reduce the overall cost. So you buy, a 1 to 2 week option after the event. The idea is to buy it right before the event and sell it right after the event, once the event and the uncertainty is over. And then when it comes to strike prices, this kind of depends on the level of protection you're looking for. I always think of that in insurance terms. Are you looking for comprehensive insurance, or are you looking for catastrophic insurance? Catastrophic insurance is obviously going to be much cheaper than buying comprehensive insurance. And that's kind of how you choose your strike prices. But that depends on your risk tolerance and the amount of protection that you're looking for, and also just generally speaking, how much you're willing to pay for that protection. But those are the general two schools of thought that I have with how you want to approach buying put protection on a portfolio, depending on whether you believe it's going to be a larger, more structural downturn in the markets, or you're just trying to hedge against a specific event. Lastly, just to kind of wrap up this session before I hand this over to Dave to show you a little bit more on the InvestorLine platform, let's talk a little bit about best practices of what you've learned here today. First and foremost, start with education. That's why we're starting off with this webinar series. We want to make sure that you have access to quality education that gives you a deep dive into option contracts, option basics, option strategies, and best practices for deploying these products in your overall portfolio. This is not something you're going to be able to learn overnight, but that's why we are doing a fair amount of webinars to help you better understand a well-rounded approach to your options education here at BMO. Second, make sure that you have a sentiment and a process. This is something that we will start to refine as we go into the other series, diving into specific option strategies. We'll give you an understanding as to when each strategy might be useful in the overall markets, what type of outlooks you should have in the underlying markets before you deploy a specific type of strategy, and make sure that the strategy you're deploying matches with the underlying outlook that you have with the underlying security. That's probably one of the places that I think a lot of investors, sometimes when you jump right in, you kind of miss out on. You kind of learn the very basics, but you don't dive a little deeper. And when you have a mismatch between your outlook and the underlying strategy, that's when outcomes may not be what you expect. So make sure that you understand, when a specific strategy should be used, and a process that you can define to help you understand when you should get in and potentially get out. And lastly, BMO has a ton of tools and resources, of which Dave is going to show you some of those tools here today, and also show you more of as we go along in our webinar series. That's going to help you take what you've learned here today, but more importantly, show you how to actually implement them using the tools that you have access to here at BMO. And lastly, I'll leave this with you, which is a disciplined exit strategy. Whenever you get into an option contract, you have exposure in the underlying markets. It's more important, in my opinion, as an option strategist over the last 18 years, when I look at traders, and I've worked with thousands of retail and institutional investors over those 18 years, the most successful traders that I see are ones that have very strong exit criteria before they get into a trade, and they stick to those exit criteria. They know exactly when they plan on getting out of a trade, whether it's at a profit or a loss. They have that planned ahead of time, and they're not figuring it out as they go along once they're in the trade. So make sure that make sure you understand not only when to get into a trade, but more importantly, when you're going to exit that trade, because that's going to help remove some emotions that you're going to go through as you're in the trade and you experience some gains and losses in your portfolio. Those emotions will have an effect on how you continue to trade your plan. So having a plan ahead of time will hopefully help you stick to that trading plan. So with that covers what I wanted to share with you here today, to give you an understanding of how to get started with option contracts and basic understanding of an option contract, calls and puts, buying versus selling. And now that you have some understanding as to when you might want to utilize options in your portfolio, I'm going to hand this over to Dave to help give you a walkthrough of the BMO InvestorLine platform and how you can utilize that platform to find and trade your option strategies.
Thank you, Tony. That was an excellent overview of getting started with options. And of course, we're only getting started with options-specific educational content. Before we talk about what's coming up next in the series, as Tony mentioned, I'd like to take a few minutes to show all of our viewers where they can access some great educational content and showcase some of the features we have to help investors easily get started with trading options. And so with that, let's dive right in. I'm logged into a demo account here at BMO InvestorLine, and for those that are existing BMO InvestorLine clients, this page will look familiar. This is the account summary page. The first thing that I'm going to take us to is actually our educational hub, where you can find all kinds of great content, including some existing options content and education. And so in case you haven't gone there before, the way to get there is to go to the right-hand corner here, click on the Education Hub. If you haven't checked this out, I really encourage you to do so. We've got a lot of great content here on getting started with BMO InvestorLine. We have topics and categories that you can select. And so we have some content and videos as well as articles on how to use InvestorLine. And then we dive deeper into actually investing using the InvestorLine platform. Since we're talking about options and that's an investing strategy, we can click on Library here. And you'll see that we've got a very comprehensive library full of all kinds of different video content. And this is a great place to go to filter and actually zoom in on educational content that we want to actually highlight. And so in this particular case, we're going to stick with videos. We can scroll down, and here's obviously some of the very numerous topics that we can zoom in on. In our particular case, we're interested in options today. We hit apply, and this is where you can find some existing video content on options today within the Education Hub. What's interesting is some of these topics nicely complement a lot of what Tony shared today. We also have a short version of an introduction to options here. We get a little bit deeper into evaluating how to look at a call option quote, some insights on put options. I'll allow you viewers to explore, but that is where you can find and how you can find educational content through the Education Hub. So we're going to go back home now. Okay, so here we are now back again at our account summary page. Let's zoom in a little bit and provide a little bit of a flyover of the options experience today. So to do that, we're going to go to the News and Markets tab, and across the top, we've got a number of different tabs that you can select. And of course, we're going to choose Options. And what this populates is a few things immediately when you come to this landing page. Number one, some of those videos that I referenced and showed you in the Educational Hub are available for you to check out here, as well as a bit of an article. And if we scroll down a little bit, we're now getting into our options chain tool. And as you'll see, I have this pre-populated right now with Apple, but this is where you could come in and type in any security you wanted. Perhaps you want to look at Microsoft. You could click on that and select Microsoft, and then we would bring up the chain for Microsoft. I'm going to go back to Apple because that's just one that I think many of us are very, very familiar with. The other option that you have when it comes to kind of populating an output within the options chain is you can actually select securities or holdings from within your existing portfolios. So that's an option as well. But we're going to stick to Apple for now. And down below is where we have the chain, and I'm going to explain this a little bit more in a minute. But up here, we have three input options that actually impact the output of what we see down below. The first option is to select calls and puts. So as you'll see, we have calls on the left-hand side here. We have puts on the right-hand side here. We have the ability to actually filter for just calls only. We have the ability to filter for puts only, and of course we can bring it back to calls and puts. I'm going to leave it at calls and puts for now. The other option we have is how many strikes that we want to show at the same time. Right now I have it selected to 6, and we can choose nearest to a particular price for Apple. So at this particular case, Apple is at 169.96. So we're showing the 6 nearest strikes closest to about $170. And so we have 3 that are a little bit lower than 170 and 3 that are either at or a little bit above 170. And so those are the 3 key inputs that effectively can manipulate what you see for the output for the options chain. Now, the other thing that we have the ability to select and customize is what expiration dates we want to be looking at. Right now, we'll see across this entire tab here, we're highlighted on March 8th, and we see that there's a W next to that. That means we're looking at the option expiration for this coming Friday, March 8th, and the W basically means that it's a weekly option. Weekly options typically expire every Friday, whereas options that have an M next to it, as we'll see here in April 19th, that's a monthly expiration. And monthly expirations happen on the 3rd Friday of every month. And we'll go a little bit deeper into that in subsequent webinar series, but that's what denotes the difference between W and M in this particular case. We have the ability to actually customize what that banner looks like. Right now I have it selected where we can show weeklies and monthlies. If I were to deselect weeklies, for example, and save that, what we can see here is all of the weekly option expirations have been removed. And if we were to select on April, for example, again, now we're looking at the April 19th, so the week, rather the monthly expiration in April, and we still have the same 6 strikes near that same price of roughly $170. Okay. The other really neat thing about this is we can actually compare the options chain for a few different expiration dates. Maybe we're interested at looking at April as well as July. And so we'll click on July as well. And so on the top here, we have the April expiration, 45 days to expiry. We have the 6 strikes, we have the calls and the puts, and we also have below the July chain, where again, we have the same 6 strikes, calls, and puts. So that's some flexibility that you have as well when you come to this options chain page. And there's actually really no limit. We can compare 3 if we really wanted to. So that's another feature or option that you have. For now, I'm going to go back and deselect November. I'm going to deselect July, and we'll stick to just April. We'll stick to our 6 strikes as well as showing strikes that are closest to about 170. And I want to show you a few other features and specifically dive into the chain here and talk about what we see for columns. So there are some default settings that you'll find when you come and open up the chain for the first time. I've tweaked these a little bit, but what we have is we have volume, we have open interest, we have change percentage, we have the last price, we have implied volatility, bid and ask for the call side, and we have essentially the mirror opposite on the put side. We're not going to go deep into what all these mean here today. We will in future webinar series, but you can hover over anything that you see this little dotted hash line. You can hover over that, click, and you get a bit of a tooltip, and you get a nice explanation about what this is. So if you're unfamiliar with what some of these column headings are referring to, feel free to leverage the tooltip. That should give you some insights and help you better understand exactly what you're looking at. Now we can customize these columns. And the way we do that is we go to customize table. And as you can see here, the ones that are selected are the ones that are already in there. But maybe, for example, we're interested, we don't really need to see change percentage. Maybe we're interested to see what the midpoint is. We have the ability to actually change the order in which these columns are presented. And we also have the ability to highlight the columns differently. Right now, I've got in the money options that are highlighted. We can change whether we want that to be near the money or out of the money. And we can also change the column alignment in terms of whether it's mirroring or it's consistent left to right. We'll just make that one change for now. And so we've updated that now. And what should happen is we should see the mid price plugged in as a new column. And here it is right here. So over here, we have the bid, we have the ask, and we have the mid. And we could play around with the placement to kind of make this line up a little bit more and even have the mid show up in the middle of the bid and ask if we wanted to do that. So that's really how we can customize the various headings or column headings within the chain. Let's zoom in a little bit more. Let's say that we're interested to buy an at the money call for the April 19th expiration. At the money in this case would be about the 170 call. But before we want to click and get to the trade ticket, this arrow here will take us to a little bit of a flyout on the analyzer tool. And so we have a bit of a visual here to highlight profit and loss at expiration. I'll dive a bit deeper into that in a minute. And we have some profit and loss insights where we talk about max profit, max loss, break even. So what price does Apple need to be at expiration for me to break even on this particular option? The break even percentage, meaning how much does Apple need to move until I hit that break even value? And we even have some insights on the probability of this option being in profit. If we click on the Analyze button, we essentially expand this a little bit more, and this table becomes a little bit more dynamic. I won't go deep into all of this. However, when we click on the analyzer, we're able to modify whether we want to buy to open. We're able to modify the quantity, which of course will impact some of the quants here and some of the P&L insights. We can change the expiration. We can change the strike price. We can even change if it's a call or a put. Okay, so that's the option that we have within the analyzer tool. And from here, we can actually click here to trade the option as well. And so what gets populated now is the order ticket, and what is pre-populated is that same expiration, the 170 strike price, the fact that we want it to be buy to open. We had 3 contracts that we had populated in the analyzer tool. We see here a refreshed view of the bid and the ask. And if we wanted to try to get a fill here, maybe we'd put out a limit price in the middle at $6.05. So we could type that in. And when we do that, we will get a notional order value and an estimated total, and be in a position where we could submit that order. Because this is a demo account, I won't proceed that way. But that is really how we can go from the account summary page through news and markets, click on options, be in a position to access some of the educational content, be in a position to pull up the options chain, select securities, and of course, play with the chain, play with the analyzer tool, and be in a position to execute an options trade. That's all I wanted to showcase for today, a quick flyover. Really appreciate all of our viewers joining us in this intro to options. I want to once again thank our co-host, Tony Zhang. You did a wonderful job. And upcoming next, we're going to dive in our next in the next component of our webinar series. We're going to dive a little bit deeper into single leg option strategies, where we're going to dive into long calls, long puts, short calls, short puts, and get a little bit deeper into what these strategies are, how to think about them, how to consider researching them and finding trade ideas, and of course, how to execute them. So please keep an eye out for when that next webinar will be shared. And in the meantime, we thank you very much. We hope you have a wonderful rest of your day.